The Dow tracking for its worst day in nearly a year following that hotter than expected CPI number. So here with more on the sell-off is Mona Mahajan, principal and senior investment strategist at Edward Jones. And I guess we'll just start out, Mona, if you think that this sell-off is an appropriate reaction to the data. I think Rick and others bring up a very interesting point about January being a reset month for prices.
Yeah, absolutely. And look, I think others have brought up this point as well, but we moved almost 22% higher in a straight line in the S&P 500 since October 27th of 2023. So were we due for a bit of a pullback, a correction, at least a period of consolidation? The answer there is probably yes. And was this CPI report a catalyst to get us there? Perhaps. And look, there was some disappointing data in the CPI. We saw shelter and rent components higher than we'd like to see. We saw headline inflation, which we thought we'd get a two-handle on, finally come in at 3.1%. But when we look broadly, the trend in inflation is still moving in the right direction. We were at 3.4% on headline last month. We're at 3.1% this month. Core inflation remains flat at 3.9%, but we think there are signals that could get us to a more moderating trend even there. And specifically, we think the real-time data in shelter and rent pricing is moving in the right direction, and that'll show up with a lag in the months ahead. So more broadly speaking, we do think that we could be due for a correction, but we don't yet see any tenets in place for a correction to become more nefarious, a bear market of any sorts, because we do see better inflation trends. We do see a Fed pivoting later this year. And by the way, we see an economy that's holding up pretty well.
And to your point there on the Fed, when the Fed looks at this, are they also going to look at the trend and say, well, look, we're going in the right direction, even if some of these components were a little hotter than expected, particularly that shelter and rent? Or does this push out potentially their decision to cut interest rates a meeting or so beyond maybe where they would have before this data came out?
Yeah, look, the Fed has already told us that they want to be patient here, and they've earned that right. The economy was going in the right direction and inflation was moving lower even as we got this better economic growth. So they can certainly be patient here, wait, we think, until probably the June meeting. And we think now the market is pricing in somewhat of a more reasonable and better aligned number of rate cuts with what the Fed is expecting as well. So the market, as of this morning, looking at 4 rate cuts beginning in June. We're in the same camp, 3 to 4 rate cuts probably beginning in that June timeframe. Keep in mind, if the Fed were to do more than that, 5, 6 plus, it's probably because the economy has faltered in some way. And if they're going less than that, 0, 1, or 2, it's probably because inflation is continuing to remain sticky and the economy is also above expectations in a more meaningful way. And so we think there's a sweet spot that's emerging, that's 3 to 4 rate cuts that gets the Fed gradually back towards a more normalized level of interest rates. And so we think what happened this morning is actually probably a healthy adjustment.
We're looking at the Dow now down 660 some odd points. I guess that would be the session low. I'm wondering, the idea of rate cuts is anything but off the table now. It just looks like the trajectory may be longer to begin, maybe a little shallower, not as steep a decline, maybe not as many. But so long as the stock market is anticipating interest rate cuts, there's really no impediment, is there, for it to continue to move higher? In other words, it's not as though the Fed or anybody is saying, hey, rate cuts are done. It's just a question of that anticipation before they start.
Yeah, I think that's well said, Tyler. And look, I think when we think about what could create or drive a bear market, usually it's if you're in a recession or entering a recession. It's also if the Fed is raising rates. And thirdly, you have your unknown geopolitical risks or an external shock that could cause disruption to the system. Neither of those three are in place today. So which makes us kind of feel like if we are headed towards a period of volatility, a correction, that's really the opportunity, especially for those market participants that really didn't get involved late last year when we got that very rapid rise in the S&P 500. So we would take advantage of periods of volatility, position yourself for that potential for that Fed rate cutting cycle that we see emerging in the back half of this year.
All right. Thanks, Mona. Good to see you. Mona Mahajan of Edward Jones. Appreciate it.